Strategy we've employed, which has been consistent now for many years, and that is to look for companies that can grow independent of the cycle. So we've been very focused on buying and holding companies that can do well either through cost out initiatives or companies that maybe have made an acquisition can be quite accretive to earnings. So in that vein, something like Mayne Pharma has been a very good performer over the last 6 months. We participated in the placement that they did to buy a US company by the name of Metrics just prior to Christmas. It's been a good performer for the fund over the last 6 months because that acquisition brings through a portfolio of new generic molecules. As they develop and bring to market, will drive the earnings growth of that business. The resources sector is quite a large part of the index, but we have a very small exposure to the resource sector and also a very, very small exposure in terms of mining services. We've always been very sceptical of those stocks, and we're quite cautious of that sector. We prefer to weight the portfolio heavily towards those companies that generate recurring income streams and pay good, stable dividends. So stocks such as Energy Developments and Amalgamated Holdings, which is Amalgamated has a debt-free balance sheet, pays a yield of about 5%. Two stable businesses, the Event Cinema chain and the Regent's Hotel chain, which generate pretty solid recurring income streams. And then an undeveloped property portfolio, which is on the balance sheet. And as management bring that property portfolio to market, redeveloping and turning to income producing assets that can enhance the earnings of the company going forward. So Thorn Group has recently reported their full year result, fairly solid result in a difficult market. So as you know, Thorn Group runs the Radio Rentals stores. Radio Rentals again delivered another year of good growth. And then pleasingly for that business, management have been investing over the last 12 months in new growth initiatives such as Cash First and Thorn Equipment Finance. And those new initiatives look like they're finally starting to get some traction. And I think over the next 2 to 3 years we can see that company delivering earnings growth, not relying on the cycle. In fact, a lot of those initiatives really do well. Radio Rentals actually does reasonably well when the economy is tough and unemployment's rising.